preamble, so if anybody joins us during that time, they won't miss too much. Okay, well, good afternoon, everybody. If we haven't met before, I'm Keith Warren, Chief Executive of the Foodservice Equipment Association. Our thanks go to Jocelyn Carr, who's our Events and Membership Manager, and Jocelyn's put today's webinar together. And to give a little bit of background, as many of you will know, the FEA is an affiliate partner to Make UK. It's what used to be known as the Engineering Employers Federation, the EEF, now called Make UK. And as part of that engagement, their work within Make UK has been focused around providing services for UK manufacturers and suppliers. And we picked up on a recent call with them the issue of R&D tax credits and capital allowances. And I know from our the work that we've done as the FEA, this is a key issue, and in fact we have a 3-point plan that looks at supporting manufacturing in the UK. So this folds into that, which is looking at encouraging government to maintain and develop services in that area. But it also becomes apparent that there are resources available that companies may not be fully utilising. And our friends here on the call from ABGI are here to give you that overview. We have Sandy Finley, who's going to go next, followed by John Lovell for this webinar, which will last probably about 40-45 minutes, and there'll be the opportunity to ask questions at the end. Or please, if you have anything as we go through the presentations, please put it up on the chat, and I'll ask Jocelyn to pull that off and ask those questions towards the end. Hopefully the sound is clear and the video relay is clear. If it's not, please do let us know and we'll try and rectify it as best we can. If we can just ask everybody except our speakers to be on mute for the start, that will be great and that will help. But without any further introductions, if I can please hand over to Sandy to take us through his slides, and we'll just transition across to the screen share to do that. So over to you, Sandy. Thank you.
Thanks very much, Keith. I really appreciate that. Right, I'm just going to try and share my screen just now with you. Is anybody seeing my screen at the moment? Yeah, you've gone. Jocelyn, I'm kind of struggling to get my screen shared here.
So would you rather that I put yours up? I can share mine instead.
If you can put the slides up at your end, that'll...
Okay.
Tell me when you've got them up. That's good, yeah. Ah, excellent. Thanks very much.
How did that look?
That's fine. I can see that. Can everybody see the slide okay? Yeah. Hi, everybody. I'm Sandy Finley, Partnership Director from ABGI. A bit about us just before we go into talking about R&D tax relief. Next slide, Jocelyn. Next slide, Jocelyn. No.
It says I'm on slide number 3. Do you want me to go back?
Oh, yeah. Should be, well, mine's is still showing slide number 2 for some reason. Yeah, just slide number 2, please. Who we are at ABGI. We're actually an international innovation funding consultancy. We help our clients accelerate their innovation activities by helping them identify and secure appropriate funding for innovation. That generally takes 3 forms. The first one is grants. We're heavily involved in that, and we're currently working with one of the FEA members this week on a potential source of grant funding for a new product. We also do tax incentives, which includes R&D tax relief and patent box. And very often, where appropriate, we'll introduce clients to or direct them towards commercial funding. Slide 3, Jocelyn. That's good.
Sorry, Sandy, to interrupt. Jocelyn, we're still on slide 1 that I'm viewing. Is the screen share on the active slide that we're seeing, or is it just locally on your machine? Because we're still on slide 1.
Yeah, I'm still on slide 1 as well just now, Keith. I thought it was my screen that was creating the problem.
Let's just take a pause for a second, if we may, Sandy, and we'll try and get that corrected.
Showing up correctly on my screen, so I'm not sure what's going on there. Try again.
Still on slide 1 at the moment, Jocelyn. You might need to click the enable editing button to clear it and allow it to move. That may be stopping it. And we're on slide 1 at the moment. If you click slide 2, does that highlight it on the right, Jocelyn? Here we go. So we're in
good. Yeah, we're getting there now. Slide 3, please, Jocelyn. The next one, yeah. That's it. Good. Thank you. Yeah, as I was saying, we're a global consulting group. We have offices in 20 countries, 200 consultants working for us, and we manage about 1.6 billion in incentives each year. Much more importantly, within the UK, we have 4 offices, we have 50 staff, and last year we realised £31.5 million benefit for clients. So that's a bit about who we are, what we achieve for our clients. Now let's just take a quick look at R&D tax relief, I think. Next slide, Jocelyn. Yeah, next one again, sorry. That's good. Okay, I'm going to work on the premise that most of you know nothing about R&D tax relief. When I run these events, generally speaking, most people know a bit about it. There also tends to be a lot of misconception or misinformation about the scheme. So R&D tax relief is a UK government incentive to encourage UK companies to invest in innovation. Headline figures are, if you're an SME in profit, there's 25% tax relief on every pound you spend on R&D and innovation. Similarly, if you're an SME in a loss-making position, you qualify for up to 33.35% cash credit or cash payment if you surrender your losses. That can vary. It can be as low as 14 to 15%. It depends very much on the individual company circumstances. For large companies in the UK claiming under the RDEX scheme, there's 9.7% net benefit on each pound they spend on R&D. If they're in credit, if they're in profit, that 9.7% takes the form of a tax relief on current or future tax liability. If they're in a loss-making position, again, they can surrender their losses and receive 9.7% cash. Within the UK, the R&D tax relief scheme allows you to claim retrospectively for up to 2 years. So currently, if you've not previously claimed R&D tax relief, you can still claim relief on your 2 previous financial years. So just now, if your financial year end is August, you could still claim relief on the years ending August 2019 and August 2018. So that allows us to claim relief on costs as far back as September 2017. If you've never previously claimed, it is possible to make 2 claims in 1 year consecutively, and that delivers a significant tax realization or tax benefit realization or a cash payment realization for companies. Next slide, Jocelyn. Thank you. Okay. For companies who are doing eligible work, let's just spend some time looking at what makes it eligible, what we can claim relief on. So the most important thing are the 3 eligible criteria that companies need to meet. The first thing is that companies need to be involved in projects that are either seeking to achieve an advance in science or technology, or which have achieved a significant advance in science or technology already. In achieving that advance in science or technology, the company has to be addressing technical uncertainty. A technical uncertainty is any technical challenge which has no existing or obvious solution. So we can't Google an answer. There's not an industrial blueprint. Somebody hasn't done the work before and shared it publicly. And where a competent professional deems that the particular challenge requires systematic research or investigation to resolve it. And the third criteria really ties itself back into that second criteria. The work needs to be managed and undertaken by competent professionals. What's an advance in science or technology? An advance in science or technology is usually something which hasn't been achieved before, or an advance in the performance. So making a particular process happen quicker, or reducing consumption of materials, reducing waste in a significant or material quantity or degree. Those would be considered significant advances in a field of science or technology. The other side to this is the costs that are eligible for relief. The largest cost in most of the businesses we work with tends to be staffing costs. So R&D is undertaken by individuals. Those individuals are the most significant part of the cost. So staff costs, their salaries, holiday, NI, and bonuses are all taken into account. And generally speaking, people will claim for a percentage proportion of staff costs. Raw materials in manufacturing and engineering tend to be the second largest cost, and that is fairly natural in terms of in engineering and manufacturing, we tend to develop prototypes that allow us to then test new designs, new concepts, and check performance. Increasingly, we're finding more companies using software in R&D or innovation processes. And if a piece of software is critical to achieving an advance or improving an achievement in an advance has been achieved, then we can claim relief on software acquisition costs. We can't claim relief on training for software because the rules of the scheme expect a company to have staff who are competent in using a particular piece of software if they're going to acquire that software. For SMEs, subcontract costs. So if an SME subcontracts research activity out to another company, then there's the opportunity to claim relief on 65% of subcontractors' costs. And then for both SMEs and large companies, there is relief against externally provided workers. Next slide, Jocelyn. Thank you. The eligible activities tend to fall into two broad categories. The first one is product development. So companies who are involved in projects that are aimed at making products smaller, lighter, stronger, simpler, safer. It may be making a product perform faster. It may be making a product cheaper or making it more reliable and more environmentally friendly. Those projects, if they face significant challenges or technical uncertainties, and those uncertainties need to be resolved to allow the company to make it smaller, faster, lighter, cheaper, then a proportion of the costs involved in that project will be eligible for tax relief. Next slide, Jocelyn. Thank you. The second area where we find, particularly in manufacturing and engineering, an increasing proportion of eligible costs tend to be in the area of process improvement or process innovation projects. If you talk to HMRC's assessors, they will tell you that process improvement doesn't qualify for R&D tax relief because by nature it's an incremental process and doesn't face significant technical challenge or uncertainty. In our own experience, we are actually finding that process improvement projects have significant challenges. So the types of projects we tend to be looking for in companies are waste minimization, waste treatment, or waste elimination projects. So any project that's aimed at reducing the amount of waste that comes out of manufacturing process will have elements of technical risk in there. It may even be reducing consumption of water. Well, we've had a lot of companies in the last 5 to 8 years who have been looking to reduce water bills, particularly in England. And the manipulation or the modification of manufacturing processes to eliminate water can often be very challenging. The second area where we see most eligibility tends to be around waste reduction, energy reduction, sorry. So companies looking to reduce the use of gas, electricity in manufacturing processes by manipulating curing times on printing or tempering times on metals will face similar challenges that have a requirement for research or development processes. Reducing raw material costs or reducing raw material consumption, or in some cases, eliminating material usage. So I don't know if this necessarily affects food service equipment manufacturers, but attempts over the last few years to eliminate both lead and chromium-6 from galvanizing processes has resulted in significant challenges for companies. And we've had a number of companies come to us with projects looking to replace both of those compounds. I think it's chromium-6 is highly carcinogenic, and galvanizers were looking to replace it with chromium-4, which doesn't have the same adhesion or protective properties. There were a lot of research and innovation projects over the last 5 years in that area. And then the final area in terms of process innovation is process automation and digitization. So any part of the manufacturing process that companies are looking to automate, if they're looking to remove human labor or human involvement in decision making, in terms of digitization, the introduction of real-time remote sensing on manufacturing lines to have better control over the manufacturing process, to reduce things like maintenance, those projects will tend to have significant challenges that, again, we can claim on. Next slide, Jocelyn. Thank you. 2 ways. Most companies that we come across at the moment are already claiming R&D tax relief. If you're already claiming, or if you haven't previously claimed R&D tax relief, it is possible to accelerate your claim. So the natural process we find for companies is to wait until their accountant is ready to submit their previous year's tax return, and at that point, make their claim. The reality is we can submit an R&D tax relief claim anytime after the last day of a company's trading year. What we find is if we submit the claim within the first 2 weeks of a new financial year, the claim gets processed, HMRC writes to us and tells us how much the company will qualify in the way of relief. We give that to their accountant, and that will sit for often 6 or 9 months until the accountant's ready to submit the tax return. Certainly in the current climate, companies who are already claiming, there is the opportunity for them to accelerate their R&D tax claim, get it in quickly, and then to submit the tax relief, the tax return on the CT600. And the quicker they can submit that CT600, the quicker they will access either the tax relief or the tax credit. In the current climate, we're finding a number of companies this year who are looking to submit losses. And if they're submitting losses this year, the quicker those losses are submitted, the quicker we can actually claim a cash credit. So certainly accelerating the claim. If a company hasn't previously claimed R&D tax relief and has the opportunity to make a relief claim for the last 2 previous years, we would normally advise running those 2 claims consecutively and submitting them simultaneously. And again, it will realise itself as one relief or one cash credit back to the company. So accelerating claims, particularly in the current climate when a lot of companies are going to show losses this year or losses in their current year when it ends, that acceleration can be a valuable tool for leveraging funds back into the business. Next slide, Jocelyn. The other option which we have found increasingly attractive just now are for those companies who are in a loss-making position and will be submitting for a cash credit, is to use an R&D cash advance scheme. So there are a number of lenders in the UK market now, if they know that a company will qualify for a tax credit payment from HMRC, they will offer to fund the gap between submitting the claim and the company receiving cash credits from HMRC. There are specialist providers for this product. There are also the opportunity to go back to your own bank. So if a company is currently using asset finance facilities from a bank, so invoice discounting or invoice factoring, and they're looking for a cash credit from HMRC, most of the high street banks will look at treating the R&D cash credit as an additional receivable. And we've seen that with 3 or 4 of the banks operating in England at the moment. So if you're in a loss-making position in the year that you're just about to claim on or just about to submit a tax return for, and you're looking for a cash credit, it's certainly worthwhile talking to your bank about a cash advance on that credit. Alternatively, if your bank doesn't want to do that, talk to us and we'll put you in contact with a specialist provider. The R&D cash advance works very similar to a working capital overdraft, in that they will look at the amount of money you're going to receive, £100,000. They will then lend 75 to 90% of that money as a cash advance, and they'll charge you a monthly interest rate on that. And as soon as the money's paid down from HMRC, they'll settle the account, and then your loan's discharged. And I think that's it. Jocelyn, next slide. Yeah, that's all I have to say today. It's worth mentioning that we also have facilities to do grant search and grant proposal writing for companies. And certainly when I did this presentation last time, about 8 weeks ago, there were very few grants available for engineering and manufacturing in the UK. Innovate UK has opened back up in the last 4 weeks, and there are now a number of schemes which will support innovation projects, particularly Sustainable Innovation Fund. There is a new round of the Innovation Fund opened yesterday and runs till I think the 18th of September. And the other one to look out for is the Sustainable Plastic Innovation Project, which is looking to help product manufacturers reduce the amount of single-use plastic being released into the environment. If you want any more information on R&D tax relief or grants, feel free to ask. Yeah, thank you, Jocelyn.
Thanks, Andy. I do have a question if you'd like to address it now, Sandy, or
yeah.
To the end. Okay. This is from Steve Witt. He's from a company called EcoFast. He has 2 questions, really. First is, does reclaiming costs on subcontractors include a company using an external design consultant?
That would depend. Is the external design consultant working on designs which will aid the performance of the product, or which will aid you in achieving that advance in science or technology? Because if their work is critical to achieving the advance in science and technology, yes, you will be able to claim that. What you would need to be careful about, though, is that when you write the commission for the design consultancy that you're very strict and prescriptive in laying down what you require them to do. What I mean by that is we require you to design this particular component or this particular product, and we need it to meet these performance specifications. It needs to be, you know, if it's about size or material, you need to build it in order to perform in the following climate, the following conditions. If you write a commission that says to the company, we need you to design a new component and lay no specifications on that, HMRC will argue that that is actually the design company's R&D, not yours. So you've got to be really careful about how you commission and how you guide them in their design processes. Yeah. Does that answer your question, Steve?
It gives a thumbs up. His second question is, what is an, quote, externally provided worker?
Right. These are workers who work for an umbrella employment agency. So we have a number of these in the UK now who employ maybe 200 staff at a time, and companies will come along to the umbrella employment agency and say, we need 10 software engineers for the next 3 months. We've got a project. We don't want to employ them themselves. And then the umbrella employment agency gives you 10 staff. They pay the staff's salaries, they take care of employment terms, and they invoice you for the cost. So that's what an externally provided worker is. Similarly, in a group situation, if you're part of a large group, you do sometimes find that the group will move staff from one subsidiary to another, or from one member of the group to another, and then apply a central management or admin charge for those staff. Those will be considered as externally provided workers from HMRC's perspective for R&D tax purposes. Does that answer your question? Good, excellent.
Okay, thank you. We've got one question, Sandy. This is from Gary Tucker. He asks, how do you calculate the percentage of eligible staff costs, and what evidence is needed for the calculations?
Yeah, it sounds really simple, but when we talk to companies, we spend a lot of time doing technical scoping with companies. So when we're working a technical meeting and writing a technical report, we'll ask our companies for an estimate of each individual involved in the R&D project and the amount of time they've spent, or a proportion of their time. So the R&D project may have lasted 9 months. Individual A may have been involved 50% of the time over those 9 months. So we then take their annual salary and additional costs, and we take 50% of that for the 9 months of the project. Alternatively, you may have a member of staff who's only involved for a number of days, 2, 3, 4 days, and we will take the full cost of their time for that period. So there is a requirement to make a best estimate. Unless you have timesheets, it's less common in engineering than it is in an industry like software, where most software development companies will keep fairly rigid timesheets. In those industries, we'll refer back to the timesheets. In terms of evidence, if you have timesheets available, they are sufficient. If you don't have timesheets, a reasonable estimate is acceptable to HMRC. The ruling is you don't need to submit any cost evidence with your claim, but if HMRC requires to audit that claim, or if they raise an inquiry against your claim, you will then be asked to show the evidence. So as an R&D tax provider, we're always firm on our companies that we maximize the amount of documentary evidence, purely to protect them retrospectively if HMRC come back next year or the year after. Remember, they do have up to 7 years to raise an inquiry or an audit on any claim that's submitted that they've approved. So they can approve your claim this year and come back in 3 years' time and say, we're now not sure that that claim's accurate. Can we look at the documentary evidence? So that's about as much guidance as there is on it, I'm afraid.
Great. That's all the questions for now, Sandy. But if
Thank you.
if there's any more from the group, if you just enter it in the chat like the other two have done.
Yeah, no worries at all. Thank you.
Great. Okay, Don, over to you. Hopefully you should be able to share your screen without an issue.
Jocelyn, do you mind to load my slides like you did for Sandy, please?
You know what? I'm having a trouble, if I'm honest. There's something wrong with my mouse. So the answer is can't do it at the moment.
Yeah. Maybe I can try at my end, but whilst we're loading the slides, I'll just give a little bit of introduction and background. So I'm John Lovell. Sandy and I work quite closely together, albeit we have different firms. So I represent Lovell Consulting, and we totally specialise in valuing capital allowances. Now, in the food service sector, capital allowances can be simple or they can be complex. And a very simple area of capital allowances would be if, say, a restaurant was buying in catering equipment. So they may well buy in, say, 50,000 of equipment, and normally speaking, they would have an invoice that would have relatively clear descriptions, and it would say equipment, ovens, and the like. And it would then be relatively simple process for their accountants, for their tax advisors, to identify the capital allowances in the tax return. So you wouldn't really need a specialist like myself in terms of routine expenditure where the invoices are very clear. And what I will address more in this presentation is where the capital allowances are a bit more complex. Hopefully, can you see the slides now, Jocelyn? Yes, so you got the slides. You can see the slides moving. So that's all good news. So where capital allowances are a little bit more complex is where people buy property assets or where they refurbish properties. So a little example here, the picture is an office, but it could equally be a restaurant or it could be a hotel. And let's supposing that somebody is buying a freehold, or it could be a long leasehold, or it could even be, say, a restaurant, a short leasehold. And when the restaurant market was strong, people were paying premiums. I think you won't see many premiums for restaurants in the foreseeable future, but let's suppose that someone is buying a property and paying a premium. Now, this tends to be a problem area for companies and their advisors. And the practical problem is there'll be a purchase contract. The purchase contract will state the price that's being paid, but often there is no separate allocation to fixed plant and machinery. So it's not very often that you would see a list of the fixed equipment that probably belongs to the person buying. Normally, if there's a separate occupier, there'll be a list of excluded assets. So if this was a restaurant and there was a separate operator, you might have a list in the back of the purchase contract of the assets which have been excluded. Or if it's something like an owner-occupier hotel, it may well be that the buyer is getting not just all the fixed plant, but all the movable equipment. But as I was saying, in practice, it's quite problematic because there's not many situations where values are neatly ascribed to the plant and machinery that's fixed, and the same for the movable. And as a result of this, relatively few companies and their tax advisors fully value all the allowances that they're entitled to. The same applies very often when people carry out actual building works. As I mentioned, if it's movable equipment, tends to be simple. There's nicely detailed invoices, and so capital allowances are routinely claimed on movable equipment. But where it is tricky is if you're engaging a builder, very often the builder's invoices will just say building work as agreed by architect, as approved, stage payments. And the problem for your external accountants and external tax advisors is they end up with a pile of invoices that are not nicely detailed. They know it's building works and they may well come back to the company and say, look, was there any plant and machinery included? And in some cases, they may get a partial segregation, but it is quite seldom to get a very detailed invoice apart from movable equipment for the building works. So this is an opportunity here. So if any of you or your clients have bought commercial buildings, or if they've spent money on physical building works, there is possibly a good opportunity to revisit to see if more allowances have been claimed. Now, the good news is there's not really time limits for doing this. There's time limits for claiming the allowances in a particular year, but if you miss the time limits for capital allowances in 1 year, you can claim the allowances in a later period. But what I can say for the movable equipment, allowances will have been picked up because it's just so simple that the invoices are clear. It will say fridges, it will say catering equipment and the like. It doesn't cause any problems to the tax advisors. There are opportunities to get cash back from HMRC. So if allowances have been missed in a current year or the previous 12 months, it's possible to amend a tax return, and by claiming extra allowances legitimately, then you may be able to get a cash back from HMRC, or if for some reason you don't want to amend an earlier tax return, you could claim these allowances in a current tax return. And you can, for certain equipment, if there was, say, specialist food equipment that was Carbon Trust approved, and if that expenditure was incurred before April this year, instead of claiming a tax relief, so perhaps you've got tax losses, you could instead get a cash repayment from HMRC. There is also a cash repayment opportunity if you've had to, say, remove asbestos from a building, or if there was contamination in the ground that you've had to remove. There is 150% tax relief for removing hazardous materials, provided that you were not the original polluter. There are some time limits for claiming in a particular year end, but if you miss, as I mentioned, if you miss a particular year end, provided you still use those assets in your trade, you can make a claim in a later period for most of these tax reliefs. And what we are finding is generally companies following COVID, cash management is much tighter, and we are finding that companies have more appetite for doing this kind of housekeeping because A, they've got the time to do it, B, they're more inclined to dig out some historical records, and C, getting a saving now or reducing a tax payment is very advantageous to them. You know, there have been some concessions from Treasury, mainly around VAT, but there have been no concessions in terms of corporation tax payments. So what we're finding is quite a few individuals and corporates are now looking to mitigate totally legitimately their tax payments by making sure that they fully identified all the allowances that they were entitled to. And as I say, the main scope is around property acquisitions or construction expenditure. Pretty much most entities can claim allowances. Property developers, it's not capital expenditure, so capital allowances are not applicable. I would guess that most of you are dealing with occupiers or trading businesses. They can claim all types of allowances. The only entities that don't benefit from these government incentives are the non-profit sector and tax-exempt pension funds, charities. This has no bearing because they don't pay corporation tax, so they're not entitled. So as I mentioned, a great place to start is to review the past. As a firm, we don't charge to do historical reviews, to do a high-level kind of scoping exercise. In practice, it's worth looking back over a 6-year period. People have normally got records over a 6-year period. Beyond 6 years, it's technically possible to go further back in time, but practically it gets harder. It's harder to find people who've kept records for more than 6 years. And this is not some kind of scheme, it's not something artificial, it's not contrived. Basically, a bit like Sandy was explaining with R&D, successive governments have tried to provide a tax incentive to encourage investment in the UK economy. There's a little example here. So let's supposing we had a dental practice and they'd refurbished the dental practice and spent $500,000 on expenditure that qualified for plant and machinery or repairs. Now in practice, all the specialist dental equipment, they would have claimed allowances because it would be very simple. There'd be invoices for chairs and tables and all the painful equipment that dentists accumulate. Where the opportunity would arise would be in terms of their building invoices, which probably wouldn't have been so detailed. Now, in this example, is an individual, so paying tax at 45%. So the allowances are a lot more valuable to an individual than they are to a corporate. And in this case, we were able to amend the previous tax return and get an actual tax repayment back from HMRC, for which the dentist was very happy. Now, some of the allowances are provided in the first year, and currently there is an annual investment allowance, and the first $1 million that's incurred on any type of plant and machinery can be written all off in the first year. That allowance is potentially going to be scrapped from the end of December this year. Hopefully Treasury might reconsider given the challenging climate. But as it stands, the $1 million first year write-off will go down to zero in terms of what has been outlined so far from Treasury. So in this example, it's possible that the dentist could have got all these allowances in the first year. However, he had several dental practices. He'd used his annual investment allowance. So instead, the allowances were spread over time, something like this graph. So had he not used his 1 million limit, he'd have got all the tax relief in 1 year. But instead, because he'd used the 1 million limit, these allowances were written down over time, but still substantial savings each year. Another example here, high street retailer, or it could have been anybody, could have been any trading business, spent $1 million fitting out their store. Now, I sometimes get criticized, why do you use such big figures? I use big figures because it's easy to do the maths. But if it was 100,000 here or 50,000, the same principle would apply. So in this example, they had 1 million of unclaimed allowances. They were unclaimed because they've not been segregated. And the poor old tax advisor just had invoices that said building works. And, you know, an accountant is only as good as the information that they are given. They are not specialist valuers. They will not segregate out of that million the lighting or the heating or the air conditioning. So it will typically get disallowed. And the clients very often are not aware of what expenditure has been disallowed. So in this example, again, substantial tax savings based on the corporation tax rate. We've shown a similar graph. Again, this graph assumes they didn't get the annual investment allowance. but instead the allowances were spread over a period of time. The one area that probably does come up quite a bit in your industry has been the carbon trust allowances. So where we do a lot of work in the hospitality sector typically. So things like energy efficient fridges, a lot of those were carbon trust approved equipment, which meant that you got 100% allowances all in the first year. Now, it wasn't such a great tax incentive because all of the assets that qualified for the carbon trust scheme, they still qualified for normal capital allowances. All that happened was you were accelerating the tax relief into 1 year rather than them being spread over time. But somewhat surprisingly, and it surprised me as a specialist, this tax relief was scrapped in budget 2020. So for expenditure after April 2020, there is now in the UK no special tax incentive for specifying or buying energy efficient plants, which seems a bit of a missed opportunity. And we haven't seen anything at all from Treasury or Revenue to indicate that this allowance is going to be replaced by something else. So that's kind of quite surprising. But if you do have clients who have bought some energy efficient products before April 2020, they can claim this tax relief, or if they've got losses, they may wish instead to surrender the benefit to HMRC and instead get a cash payment. You don't get the full value of the tax relief, it's about 50% of it. This example explains how you can get a tax payment instead of claiming the allowances. I don't propose to read it out, and I'm guessing that Jocelyn, you'll probably circulate the slides at the end. Another example here though, so this was a high street retailer. They spent $1 million replacing energy efficient lights. And again, they had tax losses. So instead of just carrying forwards losses, they decided to surrender back to HMRC and got a substantial cash repayment back from HMRC. The very generous tax relief, and probably one of the most generous, maybe alongside R&D, is 150% tax relief for removing contaminants within the building or within the ground. So if you've got buildings with asbestos, Japanese knotweed, oil, or potentially you have to divert gas mains and the like, there is 150% tax relief available. There are some time limits for claiming this. So unlike capital allowances, you have to ideally claim it within 2 years, or if you're a property developer, you may be able to claim within a 4-year window. In practice, we find very few companies claim this tax relief. And again, it's because expenditure is not neatly segregated by contractors. Little example here, some of the types of building works that this applies to. And like the enhanced capital allowances, you can surrender it for a cash repayment rather than getting the tax relief in the tax return. So we are acting for quite a few, particularly developers at the moment, who've got cash flow challenges, and they're mitigating some of their cash flow by making sure that they've fully identified and claimed this tax relief or surrendering it for a cash repayment. There are misconceptions about capital allowances. A lot of people think you have to claim it in a particular year, but as I've mentioned with most of these tax reliefs, if you miss claiming the time limits in 1 year, you just claim it in a later year, provided it's still used. A lot of people think if they claim these allowances and then they sell a property, then the benefits get clawed back. That's not the case. There is the ability in UK tax legislation where you sell a property, the seller and the buyer can agree who keeps what allowances. So potentially the seller can keep all of the allowances, give the buyer just £1. And by claiming these tax reliefs, you will not pay more capital gains tax when you sell. There really is, with plant and machinery allowances, no downside in claiming these allowances. There is a relatively new allowance called the Structures and Buildings Allowance, which was introduced towards the end of 2018, which gives effectively a commercial buildings allowance. It's a little bit like the old industrial buildings allowance. It doesn't apply to residential properties, applies to commercial buildings. It's a slow allowance. It's provided evenly over 33 years. And if you do claim that particular allowance, it's beneficial during your ownership period. But if you're selling an asset, it does result in the benefits being clawed back. So that is an exception to the everything I've said about capital allowances. And the one very common misconception we hear is, well, my accountants, my tax advisors, they do everything, they're very good. Now, I'm sure most accountants, tax advisors are very good, but they may have missed these allowances if it's construction or property expenditure, purely because it's not been segregated for them. Some of the larger firms do have similar specialist teams. If you've been dealing with those capital allowances specialist teams, then yes, you will have had this type of advice. I've concluded my slides. I'm very happy to take any questions.
Thank you, John. If anybody has any questions, they could add them to the chat section, or if it's easier, just unmute yourself and verbalize your question. There haven't been any questions in the chat as of yet, John.
Okay.
Is anybody typing?
Keith, we can't hear you. You're on mute.
You're on mute, Keith.
Okay. Can anybody hear me now? Is that
Yes.
better? Good. Okay. Well, whilst anybody's thinking of any questions, really just to say a big thank you to Sandy from ABGI and John from Lovell Consulting for a very clear and concise explanation of most allowances. In my years in this role, that's the clearest explanation in an understandable format that a layman could ask for. So thank you very much for that. What I'd also say, and John's reference is there to the energy technology list. As the FEA, we're doing a lot of work on that at the moment with BAYS to regenerate the energy technology list to cover all aspects of cooking equipment, refrigeration and warewashing equipment. And in the last week, we've been involved in 4 meetings with the ETL consultants on this matter. So that work's going on. And part of our 3-point plan involves the use of the energy technology list to allow for capital allowances. And one of those is R&D tax credits as part of that, and also tax credits based around the point of manufacture for companies to access. And this is part of our proposals we're putting forward. So you start to see an integration in our work here. And maybe, John, offline, I'll share that with you for what it's worth, because I'm sure some of the contacts you have, our 3-point plan would be useful with them.
Keith, were you surprised when they scrapped the tax incentive, first of all, and secondly, in your recent deliberations with them, have they indicated that there might be some new kind of special tax relief?
The latter hasn't been indicated. I think we were, to an extent, surprised they took it off the market, but we weren't, in the sense that what the Treasury actually wanted was more accountability for the use of that allowance based around a carbon reduction. And I think the recognition that net zero carbon by 2050 is the overarching imperative, and seeing the volume of work that's going on, not only in our sector, but other sectors that we're aligned with and where we know the organisation's operating there, there's a real cohesive force to get ETL back as a really valid entity for defining what energy efficiency equipment is. So I think whilst our initial reservations around withdrawal, we were expressing concern, what we're coming back with is going to be a stronger scheme. I think there will have to be support behind it. And what I would say to anybody on the call, we've put the messaging out regarding the BEIS consultations that are on at the moment relating to the ETL scheme. Please do get involved. The stronger our lobbying force, the more chance you'll all have of recommending to customers that they claim enhanced capital allowances at customer level. And at manufacturing and supply level, there's a chance for you to engage and support the plan to get value out of it as well. So the more input, the better it will be. I think what both John and Sandy have put together here for us, and we're very grateful to them for that, it is the cohesive approach to helping you get more money at the end of the year as an FEA member. And it's not often we have things that can help you make money, but this is a great example of helping the bottom line through the work that they can do. And please, if there is any follow-up that anybody wants, contact either John or Sandy directly, or via Jocelyn or myself, and we'll link you together. And please make use of their services if you can. Thank you. Does anybody have any questions? No? Okay. All right, that's good. Well, if I may, on behalf of us all, thank you, John. Thank you, Sandy, for your time and input this afternoon. And I have no doubt that we'll be keeping in touch with other services we might be able to provide collaboratively together in the future. And thank you, Jocelyn, for facilitating this afternoon's webinar. Thanks, everybody. Have a good rest of the day. Bye-bye.
Thanks. Bye.